All right, so maybe we'll get started with the introduction. So thank you guys for joining. If anyone's interested, this is the first of 2 webinars in a row. So you guys only have to be here for one, which is lucky. But let me go through a couple of the housekeeping items and then I will introduce our analysts. So anything you hear today is general advice. We don't know anything about you. We obviously can't offer personal advice. If you're over in New Zealand and you want a copy of our FAP, you can go onto our website, morningstar.com.au, and get that. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. But what we would want today is questions. So send through any questions. You get a chance to actually interact with our analysts, which is great. And then anyone who's interested in coming to our second webinar after this, we're talking about asset allocation in retirement, which what's more exciting than that? All right, so I'll have you guys introduce yourselves. So I'm Mark LaMonica for people who have joined these before. Hopefully you know me, but we have another Mark. So Mark, do you want to give a brief introduction and I'll put up your coverage, both of your coverage, while you guys are introducing yourselves. But yeah, Mark, you want to take it away?
Yeah, sure. Hello, everybody. I'm Mark Taylor, mining analyst by background, but at the moment, I sort of cover a mixed list of oil and gas companies within an energy company sphere and mining services companies. So in the oil and gas space, I cover the big names like Woodside, Santos, and Lesser Beach. Also some refined fuel retailers like Ampol and Viva Energy. And in the mining services sphere, it's companies like Seven Group, Simic, Downer, Worley. I also do the chemicals and explosives companies, Incitec Pivot and Orica, and a few other odds and sods like ALS, New Farm, Mineral Resources and Alumina Limited.
All right, well, thank you, Mark. So Brian, you're up. The first thing that I'll point out is that Mark covers more shares than you. Looking at this list, I mean, 4 or 5 more at least. So maybe you can comment on why you don't cover more.
Yeah, good afternoon, everyone. And thanks, Mark, for pointing out that I do work less hours than Mark Taylor, but I am a lawyer by training. So I'm very good at looking like I'm working hard, but not really doing so. What I do at Morningstar is I cover the telecom sector, which encompasses Telstra and TPG Telecom, and also a couple of telcos across the Tasman in Spark and Vodafone New Zealand. I also cover the media sector, which would include stocks such as Nine Entertainment, News Corporation, and Media. And finally, I cover the leisure sector, which includes companies such as Flight Centre, Corporate Travel, and Art and Leisure.
All right, awesome. So Shani actually just posted in their coverage into the chat as well. So I'm gonna take the slide away so that you can see us, because that's why people are on here, to see us, obviously. But send through any questions you have. But to get us started, we obviously, there's a lot going on, but fairly recently ended up or finished up earnings season. So maybe we'll start with you, Mark. So, you know, I think resources especially have been in the news a lot, but I guess in your whole coverage universe and maybe particularly in the resource space, like any surprises out of earnings season?
Yeah, and there probably shouldn't have been, because it was well flagged that, you know, there were going to be sort of cost pressures from COVID related issues. So the surprises for me were not that those costs did increase, but a number of companies that were really hit hard by higher than expected costs associated with COVID, especially in those that were in Western Australia, which as a state, which was really hit hard by that. So it was companies like Mineral Resources Limited, which had a real manning issues. So they reported lower than expected earnings. Downer, higher costs. Monadelphous, Ampol had higher costs and probably lower foot traffic through their stores, with Omicron sort of cutting petrol consumption. Worley and Alumina Limited. So those companies really were sort of hit by higher costs to a greater extent than I was expecting. And there was one that actually did a lot better than I was expecting, and that was Santos, who really managed to lower its operating costs in a period where most other companies had increased operating costs. So Kevin Gallagher doing a fantastic job in keeping their costs very low.
So obviously oil has been in the news a lot lately.
Yep.
What's your outlook? Because, we've had this interesting period, right? When COVID started, obviously oil went down significantly. A lot of oil companies then went down. You were relatively bullish that oil would come back. It obviously has. What do you think now? Where do you think the price of oil is going?
Well, we don't think that the price of oil is going anywhere different to what we've sort of thought all along, and that is that our mid-cycle Brent crude price forecast is $60 a barrel from 2024 onwards. We've got some absolutely crazy prices at the moment, especially in the gas hubs around the world, like UK national balancing point prices have actually been double or triple the price of crude oil in their energy equivalents. So the companies that are exposed to spot LNG, particularly companies like Woodside, are going to be absolutely creaming it over the next year or two, depending on how long this unfortunate invasion of Ukraine sort of carries on. So at the moment, crude oil's close to $120 a barrel. We'd expect it to stay there for quite a bit longer, and we use the futures curves to guide us over the short term, the next 2 or 3 years, before a pullback to our mid-cycle price at $60 a barrel.
Okay, and can we talk a second about that spot comment you made, just because I think maybe that went over people's heads. So of course, you're an oil company, you can sell production out into the future, lock in prices, or you can sort of sell it as you pump it. Is that kind of what you're referring to? The spot prices, they are just sort of selling it as...
To an extent, but mostly it has to do with the fact that Australian companies in particular are gas exposed more so than their North American counterparts. Often North American companies have a much larger oil exposure. Australian companies are more gas producers, like 75 to 80% of their production is natural gas. And a big portion of that they sell as liquefied natural gas. And the price for liquefied natural gas is generally linked to the crude price for Australian producers. So the natural gas price that you're going to get for your LNG reflects what the crude price was in the last quarter. But increasingly, they are looking to sell less and less gas in those gas contracts. So they sell it at spot, and predominantly into the Asian markets. The Japan Korea marker is the key marker that they sell into, and the price for that has been very, very high. At the moment, it's over $30 an MMBTU, but it's been as high as almost $60. And surprisingly, or unusually, not surprisingly, given Ukraine, but the European spot prices have been exceptionally high too, up to as high as $75 an MMBTU, which is something like 3 times the oil price in energy equivalents. So if you can sell a number of your cargoes into the spot market at that sort of price, you don't have to sell very much to be having a huge impact on your revenue. So Woodside and Santos can both manage to sell some of their cargoes into spot, but Woodside in particular has good spot exposure, so expect very strong earnings from it in the near term.
Okay. We'll get back. We're getting some questions already, so we'll get back to Woodside. But Brian, same question about earnings season. Surprises, what you expected, anything you want to highlight?
Yeah, sure. Let me start with the telecom sector. One thing that I was really genuinely surprised about is for the past 4 to 5 years, the mobile industry underwent a real intense competitive environment where everybody was discounting very aggressively and stealing market shares from each other. And we've always held this thesis that that market will become more rational. And we were actually surprised by the speed at which that rationality came back into the mobile market. For that December half, Telstra's mobile margin actually went up almost 9 percentage points to almost 42%. And then during that same period, Optus's average revenue per mobile user went up about 5%. And then lastly, from November last year to about January this year, TPG Telecom's Vodafone gained 33,000 mobile subscribers. And that's the first gain in 2 or 3 years. So that rationality returning to the market was much, much faster than what we had expected. And that's a good thing for the mobile and for the telecom industry. So that's the first thing that I'll say about the telecom sector. In the media sector, now historically, this sector, although it's not a big listed sector in the market, it actually provides a very good gauge, a forward-looking gauge into the economy. And if that is any indication, then I think our economy is in a very good shape because spending on marketing and on advertising and promotions, they are actually growing quite strongly. And there is a bit of FOMO in that because each company is looking at its competitor and saying, gee, they are spending quite a lot. We better catch up with it because we're losing our share of the voice in the market. So that's, again, a very good positive forward indicator for the Australian economy. And then lastly, in the leisure sector, and I don't think I'm saying anything surprising here, but whenever borders open, restrictions ease, the bounce back of the release of that pent-up demand to frolic, to travel around and to play, it is just so immense that it's offsetting any of the concerns that we're seeing on the wage cost, on oil price, and on fuel costs and all of those stuff. So it is quite amazing how, for instance, theme parks open up in Queensland and borders open up and the demand is just huge. And for instance, in corporate travel, when borders started opening overseas or even in New Zealand, you know, all these business people, especially men, started traveling for no reason, just to get away from their families and kids. So it's been amazing in that kind of recovery, and that pent-up demand is real.
All right. So yeah, if anyone is traveling to get away from their family and kids, put a comment in the comment section. But maybe we'll stick with you on travel. Flight Centre. So we've heard a lot about Flight Centre. Obviously, I think, you know, as restrictions started coming in, you know, people obviously knew they weren't going to make any money, but sort of very quickly people started anticipating an opening that kept getting delayed and bought the stock. What do you think about Flight Centre right now?
Yeah, let me make a general observation about the travel industry in general. We, meaning I, at Morningstar, have no crystal ball about when restrictions will completely ease, when all the international borders will open, and how many more variants of this COVID-19 we'll have over the next year or two. So the first thing we focus on is balance sheet and liquidity. Do these leisure-related companies, do they have the balance sheet and the liquidity to survive the next 2 to 3 years? And if they do, then that's when we look at the upside in terms of the intrinsic value. And on that basis, let's look at Flight Centre. Right now, they have the balance sheet and the liquidity to last 2 years, assuming that travel activities don't recover at all. 2 years. But travel activities are recovering. In fact, I think their transaction volumes are at about 35% of pre-COVID levels right now. If that stays at that level, then this company has probably money to last 3 to 4 years. Now, during COVID, because COVID forced the management to do this, cost base was really hacked into during COVID. So much so that this thing can actually break even at a total transaction volume at less than 50% of pre-COVID levels. And you can see this in real life because before COVID, if you went into a main street anywhere along the suburb, you would have seen probably at least one travel Flight Centre agency travel shop in that suburb. These days, you'll hardly see any because they cut their travel shops by almost 50%. So the point I'm trying to make is cost base is really low now. And therefore they can break even at less than 50% of pre-COVID level of volume. So on that basis, what we're estimating is that earnings will go back to pre-COVID levels by fiscal 2025. And then on that basis, we think the stock is worth $18 per share. That is our anchor. That is our intrinsic assessment of this stock. Now, whenever travel activities recover and borders open, you are going to see stock price probably move up beyond that as people extrapolate. And then on the downside, whenever COVID cases increase and we have new variants of this COVID, people extrapolate on the downside and you're going to have stock price below that anchor point. The point we're trying to make is you've got to have an anchor point, whatever it is, based on mid-cycle earnings. And obviously, Mark, we think our anchor point is better than the rest of the market, but it is up to you to decide what that anchor point is.
All right, we're getting a lot of great questions, so thank you. I've got one more from me, then we'll start getting into them. So Mark, Simic, now I was practicing saying this before we started. There was a bid by Hochtief. That was like my German attempt. What can you speak a little bit about the bid and what's going on there?
Right. Well, I think it's well understood that Hochtief has been a majority shareholder in Simic for a number of years, and they've been gradually creeping up the register via stealth through buybacks, under the creep provisions, also buying stock. And so anybody else has really been a minority shareholder in Simic for quite some time. A bid, unsurprisingly, has been launched at a near low point in the market for Simic. It's $22 a share, which is well below our standalone fair value estimate, which is $33.50. They obviously need to get to 90% to get to compulsory acquisition. And while this bid has been live, they have been acquiring shares. They've acquired another 3 million shares since March this month. So they're well over 80% now. But they still need to get another 15 million shares. So the question then becomes, what's the likelihood that they can achieve compulsory acquisition status? At the moment, we sort of give it a 50-50 chance. And hence our fair value estimate is halfway between our standalone fair value and Simic's bid, which is at $27.50. And the official recommendation on that basis is it's a 4-star stock, so we're still on the front foot. We think the bid undervalues it. But the risk is that if you hold on and the bid goes away, then you're still going to be a minority shareholder in this company that's probably going to be run in the best interests of Hochtief, not the minority shareholders. That's a risk. But from a valuation perspective, the bid undervalues it. So our recommendation is to hold at the very least. We'll be putting another update out as soon as the independent directors and the independent experts report is out, because that still hasn't occurred. But for the moment, it's a hold. Just wait.
Okay, great. So as I said, we do have a lot of questions. I'm going to try to group them logically, but I thought a good one is there's a follow-up on your comment on Flight Center from Abramson Superfunds. Have you ever been asked a question by a super fund before? So that's exciting. So the question is, if they've closed so many stores, how are they going to be able to recover sales? Is this just the transition to booking online?
Yes, that's one thing, transition to booking online, and they have invested a lot in their digital infrastructure to capture that digital audience and younger demographics who exclusively book online. But the second thing to stress is that I said they closed 50% of the shops, which obviously implies that they still got 50% of the shops operating. So what happened before was that they basically overexpanded, and some of the shops were cannibalizing each other in certain catchment areas. And what they were planning to do before this COVID hit was that over the next 3 to 5 years, we are going to rationalize our store network in a very measured way over that period, because we don't want to lose that walk-in traffic just in case, everybody have this impulse buying walking in from the street. But what COVID did was it basically made them make that snap decision in terms of rationalizing that store network straight away, and therefore saving on the leases. So I think it is a good question, and it's a question that's grappling management too, because they are now trying to delicately balance what would the traffic impact be of having 50% less shops versus the elimination of the cannibalization threat from having less stores, but in more optimal locations, and then driving that traffic back to our digital channel, which we are investing a lot of money in. So on a net basis, I think they're hoping that the traffic, the impact on traffic is hopefully less than 10%. And in terms of revenue, hopefully even less than that.
Okay, great. We've got a lot of energy questions. So maybe we'll just go through a couple energy questions. You can take a break for a second, but I've got more questions for you. We have somebody named Guy that just said, hi, Mark, but I don't know who he's talking to.
Right.
So it could be either one of us. And then Derek is just making a comment. I don't think you have anything that says Mark has been bullish on Woodside for a very long time, maintaining an estimated fair value of $40 a share.
Mm-hmm.
So I think, yes.
That is correct.
All right. So we've got the question from Guy after the hi, Mark. So I think he was saying hi to you.
Mm-hmm.
So Guy is saying, what will it take for Beach to realize their 5-star status, given that they appear to be underperforming their energy peers in the current circumstances? So I guess maybe just in general, do you agree with that? The Beach is underperforming their peers? And
yes, probably a little bit, but I noticed this morning they tipped into the 3-star zone, so they are recovering as well. Well, Beach has been in the sin bin for a while because it had a reserves downgrade, which was not appreciated by the market. So I think whenever you do something like that and you're in the naughty basket, no matter how good things get, you're going to be sort of paddling upstream to sort of get back. But I think, they're close to the point where that can start to pale beside what is going on in a positive sense, and that is the energy prices at the moment, very strong, and the fact that they've also started to reverse some of the negative reserve hit. So there's been some minor good news on the reserves front in terms of clawing some back. So I think those two things. And an important thing to remember about Beach is it is a higher cost producer than the likes of Woodside and Santos. So the leverage in its earnings should be greater in terms of commodity price rises. So while they do have, say, limited LNG exposure at the moment, and they do have a higher proportion of domestic gas contracts, which are often a bit stickier and sluggish in terms of price increases. What they lose in that regard, they gain in the sense that the earnings leverage is very considerable to any price rises that they do get. And the other thing too is if, a smaller company, exploration success can be a lot more meaningful than a company like Beach. So that's another thing that could kick them along, is if they have some success with the drill bit exploring.
No, maybe everybody watching this knows this, but what is exploration success? Just so I can learn something.
Right. Okay. Drilling for oil or gas deposits. They do that predominantly in the Cooper Basin of South Australia. So if they can, they have a reasonable success rate, Beach, in terms of their exploration. It's often not a huge increment, but it's fairly consistent incremental success in terms of their drilling.
New well that they're drilling.
So if they drill a well and it comes up, thumbs up in terms of hitting oil or gas, it's quite meaningful to them.
Okay. So Derek, basically all the things I said before, I just didn't follow up and scroll down enough. So Derek was not just making a statement about you being bullish on Woodside. He does have a question. So he says, despite the current, what he's describing as the oil shock, the large recent dividend, European inventory shortages, reduction in Russian oil purchases due to the war, the share price stubbornly remains at around $30 with occasional excursions higher, such as today. What do you think is holding back the share price from reaching your estimate of $40? Why is the market not listening to you? I think is what he's asking.
I think, like all these things, it can be a combination of things. One of the things I think has been the view over oil and gas companies essentially being companies that are in runoff mode by virtue of climate concerns and carbon emission concerns. And the thought process being that, well, these companies, you're basically buying a dying industry because renewables are going to take over. So there's been that weight on it. And I think that's a view that probably has some legs in the long run, but in the medium term, companies like Santos and Woodside are going to benefit from climate concerns because gas is a lower intensity hydrocarbon than, say, coal or oil. So if anything, there's just no way that the world's going to be able to replace energy supply with renewables in a decade, let alone, 2 or 3 decades. So they're going to be looking at maximizing their gas consumption relative to oil and coal. So they stand to do well out of it. The other point is that I think Woodside's been in a growth hiatus for a long time now. They've just been focusing on just earnings and dividends. So I think the market's forgotten that this is a company that can actually grow as well, and it does have some, meaningful expansion plans that are already in train. So you're going to see a benefit from that. So I think that's another thing.
Yeah. Okay. And Greg, you answered another question during your answer. So that was really good. The whole 2 birds, 1 stone thing. So Nathan asked a question about ESG and what you think the long-term impact would be, which I think you covered, unless you have something else to say.
Oh, well, there's that. Gas can be very important if hydrogen economies become a more bigger deal, and it looks like in Japan that they're going that way very much so. Companies like Santos and Woodside can export their natural gas as ammonia for the hydrogen industries in Japan, and they can also sequester carbon in their old reservoirs. So that's a very meaningful business for them potentially. So this carbon sequestration in their old reservoirs means that they can potentially be quite green companies and still produce hydrocarbons going forward.
Okay. Well, thank you. One last question for you, and then we're back to you, Brian.
Mark, can I just say on ESG, don't get Mark Taylor started. We could go on all day here. So
I've got another webinar at 1 o'clock.
Yeah,
though.
so I think you should, don't ask him.
But we could
about
also all
ESG.
just leave, and we'll just leave the camera on, and Mark can just
we can
talk
do that,
for the rest of the day.
24 marathon, yeah.
Okay, so the last question that we'll ask you for a little bit comes from Howard. So Howard is saying, how will high pump prices affect Viva Energy?
Not very much, particularly in an immediate sense, because the cost of crude oil is generally passed on to consumers at the bowser. So it's a pass-through sort of exercise. So it doesn't impact the company's earnings in an immediate sense. But if high prices persist for a sufficiently long time, then you're going to get some reduction in demand potentially. People will be a bit more scrimpy on how they drive and that sort of thing. But I don't think in the short term that there's a lot of alternatives. So short of people being locked away in COVID lockdowns, you might get some minor loss of demand around the edges, but I think that these sort of companies will be pretty immune to it.
Okay, great. All right, Brian, you're back on the hot seat. So you know you can't come to any of these without some Telstra questions, right? So we've got two. We'll put them together. So one from Jill, and they're kind of pretty similar. So Jill says, it seems like Telstra's stuck in the dark ages. How are they keeping up as the environment around them evolves? And then Lisa has a question. Lisa also has 3 alpacas.
All right. Okay.
Yeah, so
Congratulations, Lisa.
She's had them for a while. These are not new. I watched the video of them getting shorn once. It was terrifying. They emitted this horrible sound. But Lisa's question is, does Telstra continue to be a viable investment through somewhat stagnant share price and dividend? So they're both kind of related. What's going on with Telstra? Is there a future as an investment, as a company? Like what's happening?
Yeah. I think the first thing I'll say is I think it's a little bit unfair to say that Telstra is living in the dark age, because I think we have to step back and recognize that Telstra does power a lot of our telecommunications infrastructure in this country. But I get what you mean by dark ages in terms of the operating philosophy, in terms of the bureaucracy and all of that. But I do believe that the company has rectified that to a great extent over the past 3 years. Because remember, under T22, NDPen and the board's T22, the company has basically ripped out $2.5 billion in costs over the past 2 to 3 years. And that's part of the modernization process in terms of becoming more efficient. And so that we have a situation where this company is still bloated, despite that $2.5 billion cost out. And then over the next 2 to 3 years, the management has already said we are going to rip out another $500 million. The point I'm trying to make is that cost out well is really deep. And therefore, whenever they have earnings challenges, that's the well they'll go back to. And the good thing is, if you're a Telstra customer, which I am, and I think certain parts of our company and probably your household is too, is that despite all those cost cuts and staff cuts, you probably have not noticed anything different about how you interacted with Telstra. And some of us, especially the younger ones, and I consider myself to be a young person, you would have experienced all these Autobots and things that you interact with to get your problem solved. And it's actually quite good in terms of solving those very simple problems that used to have to be on the phone for 35 minutes for in the queue. So what I'm trying to say is, yes, it is coming from a dark age, but it is improving. Costs are coming out and they are becoming more proactive in terms of their product simplification. So only about 2.5 years ago, if you went to a Telstra website or walked into a Telstra shop and you said, I want a mobile plan, they would have given you a 16-page brochure with about 250 plans. And you would have gone, whoa, which one should I do? And they'll obviously tell you to get the $150 per month most expensive plan. What they do now is they have 20 plans. So basically, the bureaucracy, the less bureaucracy, the simplification has made Telstra a more modern company. And then on top of that, they are digitizing everything that they do. And on top of that, and this is very important, they are now sweating all of their passive infrastructure. So in the old days, it used to be a size game. You know, we just want to be the biggest and we want to hoard all these assets. We are going to continue to invest in them. Now they're saying that, you know what, we need a return on all these infrastructure. And so the first cab off the rank last year were all those mobile towers that they own. They sold 49% of all those mobile towers to a bunch of super funds for, I think it was $5.9 billion. The absolute amount doesn't mean anything in a vacuum, but that was 28 times EBITDA. That is quite rich, even for an infrastructure asset. So that's just the first cap off the rank. And going forward, I think they may monetize some of their fiber assets. And then depending on what NBN does with its ownership, I think NBN will be corporatized in the next probably 3 to 4 years. There is a chance that they might try to monetize the fiber assets by doing some sort of a deal with NBN. So in summary,
Telstra's exciting.
I think you have to look a little bit deeper, but I think there are some excitements to be had. Certainly not as exciting some of the things we do during the lockdown, but yeah, I think there are some exciting things to canvas in Telstra. Now, having said that, in terms of the stock price, though, again, I think some people have this view that stock price has been stuck around current levels. Not necessarily so. I think over the past 2 years, Telstra stock has done really well, so much so that it is really no longer our preferred stock in the market. In fact, it is around our intrinsic assessment of about $4 per share. So yeah, so those are my views on Telstra, Mark.
Okay. You know, fun fact that when Shani was in uni, she worked at Telstra. So she would have been one of the people that brought that brochure and then forced you to buy the $150 plan. Yeah. So,
And as you can see, Shani is with us now. So
all right. So we've got another question, I think, about keeping up with modern technology from Amy. So she's saying, how are the media and entertainment stocks going to compete against the growing adoption and use of streaming services?
yes, that's a very good question. And then if you actually look at the financials as they currently stand now, you probably won't see that in financials. For example, if you look at Nine Entertainment's results of the past 2 years, you would have said to yourself, hey, I thought all this digital technology was eating into traditional media. Not so, because what COVID has done is basically force people to stay home, get isolated. And then we started watching all sorts of crap across all different medium, whether it's digital, Netflix, or even Nine's own free-to-air. Free-to-air viewing went through the roof during COVID. I myself don't watch free-to-air, but apparently there are.
But you heard people do?
Yeah, apparently there is some reality shows about married couples getting married without seeing each other first. I wish I would have known that when I was at uni. But there are many of these shows that really sucked in audiences and really drove advertising to real great heights. But I think Amy is making a good point. We shouldn't lose sight of the fact that traditional media is under structural threat. So that when restrictions ease and we start frolicking outside and not being cooped up inside, I think those threats will come back to the fore. And so this is why I think whenever media stocks go way up in terms of stock price, you have to be careful not to extrapolate those advertising and earnings growth that they're seeing during COVID, because that's not normal and that will normalize over time. And therefore, the multiples that you're paying for these stocks should be measured in terms of assuming that earnings will continue to grow at 10 to 15%. Now, in terms of getting exposure to those new digital technology things, now Nine does have some exciting digital assets. I don't know whether Amy knows, but Stan is owned by Nine. And in fact, last night I was at Stan's new strategy briefing where they showed us all these exciting new TV shows that they're doing. And then they were trying to convince me to watch the Sonny Bill Williams fight with Barry Hall, which also is owned by Stan, and that lasted for about 1 minute 50 seconds. So that was a good use of my time, waiting 4 hours for that. So Nine does have some exciting, and Nine also owns obviously Domain, which is considered a digital technology company. And then also News Corp. News Corporation does own some very good, exciting digital assets, such as the REA Group and the Wall Street Journal. Believe it or not, it is a real exemplary example how an old masthead, traditional newspaper masthead, has come into the digital age and really growing their digital subscriber base. So there are some exposures that you can have to that digital technology through some of the listed Australian media equities.
I would like to point out that I've probably done 175 webinars or something since COVID started. I've never once used the word frolic, and you've used it twice.
Frolicking is good.
There we go. All right. So we've got one more question for you. Southern Cross Media Group. So the question is from Charles. And so based on your comment earlier when you were doing your introduction on media spend, when do you anticipate this actually showing up in the share price?
Yeah, the honest answer is I don't know. I don't know when. All I do know is that on a rational basis, we do think Southern Cross shares are really, really undervalued. And the last Friday, we actually published a research showing that, just don't trust our words that it's undervalued. Let's have a look at some transaction multiples that just happened only 2 months ago. First one, Seven West Media bought a bunch of regional TV stations at a multiple of about 3 times. Southern Cross has some regional TV stations, which they're trying to flog. At around the same time, ARN, which owns a bunch of radio stations, and one of them you would know because, what's his name? Kyle and Jackie O, they're on it. The owner of that network bought a bunch of regional radio station at a multiple of about 8 times. That was only 2 months ago. Now, if we use those transaction multiples on Southern Cross's regional radio and regional TV stations, you easily get to a valuation of $3 to $3.50. And on top of that, Southern Cross owns its own metropolitan radio network, including Today FM and Triple M network. So that's another way of saying the market realizes there are corporate buyers buying these assets at pretty attractive multiples, and yet the stock market is not recognizing those values. And guess what? This morning, Southern Cross came out and said, you know what? Since you guys are not buying our stock, we'll buy our own stock. So they announced a buyback. And I think this is the beginning of a long capital management journey, because this morning, they also announced that there are a bunch of people looking at our regional TV stations. So if they do succeed in selling those, I think that will be the next step in the capital management program. And then while you're waiting for all of those capital management program and initiatives and waiting for the earnings to come through their radio division and TV division, you are getting paid 6% fully franked yield while you're waiting for all those catalysts to realize themselves. So on all aspects at current prices, I think the risk reward is on your side.
And you think that dividend is sustainable? And
oh, definitely, because, well, first of all, they got so much balance sheet power that they're doing a buyback. And secondly, just to give you a sense of the balance sheet flexibility, their net debt to EBITDA is currently 0.7 times. And the covenant, the banker's requirement, is 3.5 times. So that just shows you how much sort of a headroom they have on their balance sheet.
okay, great. I will say that you know a lot about not only the shares that you cover, but also all the television shows that they have and radio personalities.
Yeah, I
Do you consider this work, or is this like,
I treat my job very, very seriously. Yeah.
He has spare time because he's not covering as many companies as Mark, for example.
Yeah. And I strongly recommend, I think it's a program called Love Island. Great program, very philosophical, and everybody should be watching that.
All right. Well, I will keep up with Brian's thoughts on Love Island and share them with you guys. I'm going to go back to you, Mark. Still energy. Kind of following up on some of the ESG comments you made, which apparently you can talk about forever. So Angus is asking, aren't energy companies future-proofing themselves by looking at renewables like molten salts, which I'll admit I do not know what that is, and hydrogen? So
aren't they? Is that what?
No, he said. Well, he's saying, yeah.
Yeah.
So is this? I guess you talked a little bit, obviously, about how, even changes that climate change brings about, like they can profit. Are there other things as well that they're looking at?
Other things. I mean, in terms of their existing business, as I said, he mentions hydrogen. I mean, you can, once you get a sufficient base load of renewables, produce green hydrogen, which takes renewable energy and converts it into hydrogen. But I mean, it's a very energy inefficient way of using energy, as it were. So gas companies can certainly play a part, especially in the medium term, in terms of generating hydrogen in the first place, using their natural gas, and as I said, potentially sequestering any carbon in ground. I've forgotten where I was going with the thought now. In terms of and they themselves, as I was going to say, while being hydrocarbon companies, they are also exploring and increasingly moving into the renewable space. So not just utilising their existing hydrocarbon reserves in a more green manner, but also looking at moving into all-out renewables space outside of hydrocarbons as well. And a number of companies, Woodside included, have hinted at projects that are not hydrocarbon based, but are truly renewable projects.
Okay. Here's an interesting question. I think it's interesting. I'd like to hear your answer. John wants to know, is with oil, does Australia have any chance of being self-sufficient?
Well, we never say never, but I would probably think not in terms of oil. But then my point would be, well, why do you want to be when you've got as much natural gas as we have? If you wanted to become self-sufficient in road transport, you wouldn't be doing it, I think, from an oil perspective. You'd be looking at natural gas, LNG in vehicles, and already Woodside sells quite a bit of LNG for trucking and that sort of thing. And then also using natural gas to generate electricity and use electric vehicles. So we could become self-sufficient in terms of our transport, but not using oil. And as I said, why would you necessarily want to be using oil anyway?
All right, good answer. So one more for you, then we'll go back to some telecom because we have some other questions. So Rodney is asking, what are your thoughts on mineral resources capitalizing on its large lithium resources? So everyone loves lithium now.
Mm-hmm.
Any thoughts on lithium and mineral resources?
Yeah, it's a very tricky space because lithium, while it's been around for a while now, it's still an emerging potential market. And whenever you've got markets that are in an emerging phase, you're going to get huge volatility in prices, while a natural base load of production and also demand is established. So there's always going to be big mismatches in the early phases. One minute you've got excess supply, and we had that very recently, and prices tanked. And now we've got the reverse happening and things are improving again. So you're going to get a lot of volatility. So you have to live with that. The other thing is lithium is not the only thing that Mineral Resources is into. It's got a big iron ore exposure. So at one minute you could be hoping to get a big boost out of lithium, and you would, but it might be buried to some extent because there's a decline in iron ore pricing or a decline in their other businesses. So it's difficult to say anything in an absolute and conclusive sense. They certainly will benefit and already have, and they've already monetized a big chunk of it by selling half their project to Albemarle. But it's not a lay down misère, I would say.
Okay. TPG. So Anthony says that the fundamentals look quite poor on TPG. And he lists the PE and yield, et cetera. And says Telstra is the market leader and Optus is running second. What do we like about this company? What is attractive about TPG?
Yeah, Anthony, I actually think there are a lot of avenues for earnings recovery over the next 2 to 3 years. And I'll just talk about a few of them, but there are actually quite a lot. Number one is that the NBN has reaped about $120 million in earnings from this company over the past 2 years. But the good thing is there's only probably $30 million left to lose to the NBN. They only have about 50,000 ADSL customers left on their own network. After they lose all of that, I think they start thinking about gaining some of those back. So I call this the revenge of the telcos against the NBN over the next 2 to 3 years, because now that you lost all your customers to the NBN, you are now trying to cherry pick and steal them back onto your own network using 4G and 5G powered fixed wireless. So if you can do that, for every subscriber, you can re-migrate from the NBN back to your own network, you earn extra $20 to $30 in profit per month per subscriber. So for someone like TPG, even if you steal 100,000 subscribers, that works out to be $20-30 million. Quite easy money if you can cherry pick them properly. And this is the reason why they're investing in all these cell towers and the density infrastructure around certain suburbs to do that fixed wireless strategy. So that's the first thing. The second thing is this company has lost over $120 million over the past 2 years due to COVID. The reason for that is travelers, immigrants, and students. Vodafone has disproportionately higher share in these segments. And so they suffered the most over the past 2 years. I think they'll get most of those back over the next 2 to 3 years as borders open and as students come back. The third thing is, and I talked about this before, over the past 4 to 5 years, we went through this really intense competition in the mobile industry. And because of that, TPG lost about $190 million in earnings because of that competitive intensity. Over the next 2 to 3 years, we think most of that will come back because I've already said to you that rationality is already returning in the market, and we're seeing it in the results. It's not just my unfounded views. So that's another one. And then on top of that, we have about $150 million in synergies coming through that TPG Vodafone merger. And then on top of all of that, about a month ago, TPG signed a network sharing agreement with Telstra in regional areas. And that presents an upside because, believe it or not, I don't know how many in the audience are living in regional areas, but TPG's share of mobile market in the regional area is probably less than 10% compared to about 30% in metropolitan areas. By having this network, by having this coverage, they can now increase their share in regional areas. But not just that, by having your population coverage increase from 96% to 98.8% because of this network sharing deal with Telstra, they can now go to enterprises in metropolitan markets and become a real viable option to Telstra or Optus in selling these enterprise or corporate packages because they now have the regional coverage to match it. So those are some of the potential sources of earnings recovery or earnings growth coming for that company. And on top of that, I think 5G, I mean, I can talk about 5G for a long time, but 5G is...
It's your ESG.
It's my ESG, but it's 5G. And one thing that I'll leave you with is under 3G, 4G, basically it was very simple. One size fits all. I'll give you a plan at $50 per month, and then everybody's on that plan. And some people will clog up the network because they're playing games, virtual games every day, 24/7. And some people were just checking their emails. Under 5G, because of the technology and the network slicing capability of it, you can actually start doing differentiated plans. So you can actually sell all those Fortnite players extra packages for more, and you can sell light users less money. In aggregate, they should be able to earn more money, more revenue. And in terms of cost per data byte provided, it goes down. So you have that positive jaw opening. So that's a good thing from 5G.
Okay, well, we will save the conspiracy theories about it till later. But one last question for you, Brian. Once again, from the Super Fund. So Super Fund must have liked your first answer. So a little bit out of left field here, but this was actually asked at the AGM, but he got a fob off answer. Why doesn't Telstra diversify like Wesfarmers and invest in different businesses, considering they have all that free cash flow?
That's a very good question. My answer to that is if they diversified in any way, I think they will be punished by the market. Because unlike Wesfarmers, which has a 3-decade track record of doing the right thing, being disciplined with the acquisitions, and knowing how to invest and grow consistently, Telstra does not, with all due respect to Telstra, Telstra does not have that track record. In fact, it should be slimming down even more. So if they all of a sudden went into, say, supermarket business, I think the stock price will probably go from $4 to $1 in a straight line, because they just have not put the runs on the board to warrant that kind of expansion. And I think Mark Taylor used the word sin bin and naughty bucket and all of that. Yeah, I think Telstra's in that. And until it can sustainably get itself out of those buckets, I don't think the market will like Telstra diversifying into anything.
And I think that there's a correlation between when Shani quit her job at Telstra and the share price decline.
You mean since you quit, Telstra price has gone down or gone up?
Gone down, and then when I started at Morningstar until now,
The share price went up.
Right.
Wow.
So, Mr.
anyone-
Superfund, Shani is your leading indicator, not me.
Yes, exactly. So we'll keep you all abreast of Shani's movements. All right, so we're gonna call it there. So I get a 4-minute break, 3-minute break now until the next webinar. But do want to thank you guys for joining. I will send out a recording of this to everyone who registered afterwards, so you can watch it again, count the number of references that you made to frolicking. But anyway, thank you guys very much for joining. There were a couple questions on shares that these guys don't cover, so I ignored those. Didn't think you guys wanted to comment on Magellan and AGL, et cetera. So that was deliberate. So I was trying to keep things to their own coverage because that's only fair. But anyway, thank you guys very much for joining. If anyone is back in 3 minutes for the double webinar, I guess good luck. Thank you.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.